Hey folks, Shawn over at the Annuity Expert. In today's video, we're going to explain our reasoning why you should keep investing separate from purchasing an annuity. This is the separation of church and state. Okay. Usually when you go to your financial advisor, they are going to use words like comprehensive, where they go through your entire assets and they want to divvy it out in certain ways. So they want to put some here to invest. They want to put certain here for life insurance. They want to put certain here for annuities, for retirement income. And I'm here to tell you that there should be a separation between insurance and investing. It really goes back to the phrase we use every day. Don't put all your eggs in one basket. Well, it's the same thing with your assets. You're literally doing that. When you go to a financial advisor, in most cases, you are literally putting all your eggs in this one basket for this financial advisor. So you're going against that common sense train of thought. And I think insurance should be a separation of church and state from investing. Go to the financial advisor, have them invest your money all day long, right? But from the annuity standpoint, if you're going to use an annuity or if they advise on getting an annuity, I would say you are likely to end up in a not the ideal scenario to get your whatever, retirement income or your bond alternative or whatever it is. Let me explain why. Financial advisors have to answer to somebody, and they are only allowed to sell a certain short list of annuity products. Those companies that they represent are usually fantastic companies. The problem is those companies have shit products. And what's going to happen to your bottom line is you're likely, not in all circumstances, but way more, there's a higher likelihood that you'll be in a position where you get less income, lower upside potential, shitty indexes, a product that is not designed for your specific scenario. It'll be part of a cookie cutter process that is in place. You're just putting yourself in a position where you're getting less. And with annuities specifically, you shouldn't be accepting less. You should be accepting more. You should be getting the highest income payout. You should be getting the most upside, or the most upside with traditional indexes. That's important. We'll go over that in a minute. You should be paying less in fees. If a financial advisor charges you a fee as a total portfolio, he's ripping you off. Annuities are self-managed. Okay, you shouldn't be paying a fee to somebody where something basically manages itself. Okay. Let's see what else. Lower bonus, the product's sold wrong. Or they're just not educated in it. Okay. So when I used to train financial advisors would typically create a process, a cookie cutter process, and they would pick 1 to 3 annuity products. Hey, we've got 3 different avatars, and every time we're going to sell this product, whether it be the Allianz 222 or the ABC annuity or Prudential, and whoever walks in that door, this is what we're going to sell them. Regardless if it pays you, the consumer, a higher income or more upside or lower fees or a higher bonus or more liquidity, you're ending up with a middle of the road or shitty annuity product. And then sometimes you're charged a fee for that. I've talked about this in other videos. There are actually MIGAs out there where financial advisors are charging a fee to manage it. For those of you that don't know what a MYGA is, it's just like a CD. You get a fixed interest rate for a fixed period of time, And after that period is up, you move it to another fixed account, earning a fixed interest rate for a fixed period of time. Why are you paying a fee? Why are you paying 1% or more or higher each year for something that's guaranteed, right? Doesn't make any sense. That's what happens, right? So the reason why it should be a separation of state is most annuities are insurance products. You should stick with an annuity broker. That's going to get you the best deal possible. Keep your investments with the financial advisor. They call it assets under management. Let them manage those assets and keep them totally separate. This way, you have a higher likelihood of getting a better product on the annuity side. And if that financial professional loses your money because of some sort of stock market event or crypto or whatever, it's not going to affect, a poor decision like that isn't going to affect your annuity, right? Which is self-managed. The only time that I would ever think that you would use a financial advisor for an annuity is if you had a variable annuity. And most of the time, variable annuities aren't worth the fees, you know. You should be in the market anyways, right? So I've had another video about that. Variable annuities, same thing, separation of church and state. Use the annuity for lifetime income. Use the annuity for a bond alternative with a fixed index annuity. Use the annuity as a CD alternative. Don't pay fees for somebody to manage those annuity contracts because they manage themselves, right? And it puts more money in your pocket, you know. And then anything that's investment where they have to pay attention to the market, then you pay a fee for the investments. And if you do that, you're diversifying your assets, you're diversifying it in a way that is more beneficial for you rather than the financial advisor. And then you're going to pay less in fees, and you're going to have a truly, you've created an extra layer of protection for your assets in the future. So you shouldn't pay fees for something that is guaranteed or is not exposed to risk. And most annuities are not exposed to risk. So, and there's maybe 1 hour of work per year for managing an annuity contract. You're going to pay a 1% fee for that? I'm not. So hope that helped. Keep them separated, as the offspring would say. And we'll catch you on the next video. See you.